Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Friday, June 14th, 2024. In today's episode, we will start with bringing up the University of Michigan Consumer Sentiment Report. This is a favored leading indicator of many economists, showing how confident are consumers in buying stuff. Basically, it's a survey that goes to a bunch of random people across the United States and asks them things like, are you going to buy a new fridge within the next year? Are you going to buy a new car? Are you going to do all sorts of things? And depending on those answers gives us this number. And the number that came out today was quite a bit lower than expected, I believe. Expected was in the 70s. It came out pretty low at 65.6. Again, this reading is a preliminary number, so this is based on a smaller set of data. And so they will come out with a revision, and the actual number might be higher, and it might actually be lower. As you may know already, whenever I get data, I want to see it on a chart. I want to see, well, what has it looked like before, or where does it seem like it's going? This current chart is of the University of Michigan Consumer Sentiment Report, and 65, by the way, is here. It's not yet updated on this chart, but it's down here. And so this line, once it's updated, will show a straight line going down to 65. They might not update it until, again, this is a preliminary number, and so it'll get revised at least once, maybe twice. Notably, if you go back through the history of this chart, during a recession or right before a recession, you typically get a very large tanking in this metric. It is important to note that that doesn't always result in a recession. You have plenty of periods where you have a collapse and we don't have a recession for many more years. But then you can see big collapse during a recession, very, very big collapse here. But this one here in, as 2006, we had a significant drop, but then we had a recover. But, even looking here, have your lower high and your eventual lower low. And so, this isn't the kind of indicator that outright predicts recessions. The best ones that we use are usually the 3-month, 10-year yield. When that's inverted and then it uninverts, that's predicted every recession with like 100% accuracy. But this one helps guide us to see what may be coming in the near future, and it's good to combine it with other data. Again, 2011, 2012, huge dip in consumer sentiment. Everyone was scared. That might have been actually when metals, we had a huge peak in silver, and then silver was crashing. This probably had something to do with that, rush out of commodities. But then it spiked up higher, and we went up higher for quite a long time. And so, since 2020, notably, overall, by the way, we've been in a lower area than we were before COVID. So COVID ranging around here for a while, and ever since then, never really getting back up to that pre-COVID level as far as consumer sentiment goes. I will note that past COVID, getting down to a level of 50, it set off a lot of alarm bells for a lot of people, including myself. If you look back throughout this chart, we've never even seen, it's never been that low in the whole history of the chart. But since then, we had a nice recovery. And so one of the questions I have is, since this tends to go down so dramatically during recessions, if we have a recession, how much further is there to go? Can this even get to 40, 30, 20? I'm off the charts if we have a bad recession. So that's University of Michigan Consumer Sentiment in a nutshell. That came out at 10 a.m. this morning. Next subject, a break in HYT. I'll go over that when we go through the charts, and I just wanted to share my overall opinion right now in markets, especially on the S&P 500. In my own estimation, when I combine everything that I know and everything that I see going on, in my strong opinion, the higher it goes, the harder it can crash at this point. We're not seeing earnings going up and up and up on the S&P 500. In fact, we have a lower high since 2021, and the price is getting way ahead of itself, and I'm sticking to this until it plays out, really. The higher it goes, the harder it can crash. Moving on to the stock charts, this is the S&P 500. I'll zoom in. This is a weekly time frame, each bar representing 1 week. If you were just a technical chart pattern analyst, you'd say, well, yep, game on. We're bullish. It's going up. It looks like it'll keep going up. Similarly, on a daily bar chart, higher high, higher low. Let's try that again. Higher high, higher low, higher. We can even count that one. Higher high. No, that doesn't count. Higher high, higher low, higher high, high. You know, patterns like this, the trend's your friend till the end. I mentioned in the introduction to the video the HYT breaking here. Notably, we've had this sort of support line here that we broke right through today. And so I'm finally seeing a little bit of nervousness in HYT. This is all while Treasury bond values are going up and yields are actually dropping. And so if Treasury yields stayed flat, this would even look more bearish. This would even look like a larger break to the downside. We'll see what comes out of that. I noted the last 2 days I was surprised that this coiling up broke out to the upside, and like they say sometimes, is it a breakout or is it a fake out? And it looks to me like this was definitely a fake out, and we are seeing pretty decent sized weakness here in HYT. The VIX, the pricing of options contracts, had a decent pop today, especially percentage wise. On a closing basis, it went up only 5%, but intraday, it was a pretty decent sized pop. It doesn't look that way from this chart just because, you have to realize there's the lower you go here, the smaller the movement is, the bigger the percentage of that movement is. Gareth Soloway on his morning show, I believe, mentioned, maybe it was midday show, I don't know. He did mention, though, today that he believes institutions are starting to really soak up some protection against downside movement in markets. I continue to be amazed at how you can have such a divergence between fear and greed index and what's going on in the price of stocks. We were at 38. We're firmly in fear. Yesterday was at 43. We went down 5 points to 38. Last week, and last month, we were hanging out in the neutral zone for quite a bit. Now we've veered into fear. We'll see how that plays out. Is the price of the S&P 500 right and CNN fear and greed index wrong? I have a feeling it might be the other way around. I wanted to bring up the CME Fed Funds Futures, the Fed Watch tool. Very notably, there's been a shift. If you were looking at this chart a month or two ago, you saw on the whole chart, looking out to the future, only maybe 2 cuts, maximum maybe 3. And now, going up through July of 2025, we see 1, 2, 3, 4, 5 cuts priced in, and we're even getting a very smidgen of a chance of actually an additional 1, 2, 3, 4, so 9 cuts by July 2025. I think the recent CPI, PPI data, along with the unemployment numbers going up, along with initial jobless claims spiking up, along with the University of Michigan survey starting to really tank, all of it together suggests that we're headed into a slowdown. Everything except for the price of the S&P 500, which at this point, I don't know. I feel like calling that dumb money at this point, but who am I? I'm just the guy with the crystal ball. TNX 10-note treasury yield, notably still breaking down from here. I do want to note, it wasn't very long ago. Let's see, the end of April, where this peaked at 4.7%, and we dropped half a percentage, half of 1% of yield on the 10-year treasury note. It's a pretty large move to the downside. Similarly, in the 30-year treasury bond, going from 4.83% now down to 4.35% today. As yields go down, TLT is probably most people's favorite vehicle of getting exposure to that, because you can buy it, you own shares, you own the underlying assets of the fund indirectly. This is TLT, and any which way you look up at it, this is starting to look more and more friendly, more and more bullish. First of all, we had this channel here, very, very clear, very well established channel in TLT, looking like what does this look like? It's a flag. It's a bull flag. We broke out to the upside, and since then we've been making higher high, higher low, higher high, higher low, higher high today. And my expectation is for this pattern to continue. After all, the trend is your friend until the end. Again, the beautiful thing about TLT is that typically when this is going up, the cost of borrowing money goes down, which can actually make stock valuations relatively more attractive, and so it can support them. It can give them more of a rise than they already have. However, when stocks go down and people start to really run away from stocks in a fear kind of scenario, money tends to go into treasuries, and that movement would send this even higher. So the fact that it's already going up without people running away from stocks right now is pretty telling. The next chart is silver. I talked about this for a little while ago. An M pattern here, double top, breaking to the downside, and this is pretty clearly a bear flag, using this red candle here going down, a consolidation. It's likely for this to, increasingly likely for this to continue breaking lower in silver. Wood, one of my other favorite leading indicators. This is funny enough, I just noticed this pattern today. What is this? What do we call this? Double top. Pretty darn clear double top, actually. And so if we break this previous bottom of this M, we can expect this to actually continue lower. Last two charts, I'm referring to this as dumb money at this point because of the overvaluation. SMH Semiconductors, new all-time closing high. Same in the triple Qs, new all-time closing high. I'm flabbergasted, but here we are. Last point, I'm just going to reiterate what I said in the beginning of the video, my opinion on the S&P 500. The higher it goes, the harder it can crash, and when it does, it can take a lot of things with it. That's all I have for you for today's show. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.